Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. Today, I want to talk about 5 tax deductions that disappeared for 2018 that you definitely need to be aware of, okay? Because with tax reform, a lot of stuff happened with tax reform. A lot of things became effective January 2018 because there was so much going on. A lot of information was going around. You know what? It was just a lot. Okay. For this is one time, it was really just too much. There was too much going on between the government and tax reform. And usually, like we had our last major tax reform in 1986, and that took some years to get to. And with this tax reform, it was done in a microwave, okay? And so there was a lot of things that were still going on, still being worked out. The IRS is still writing language, if you can believe that, okay? So here we are, it's September of 2018, and the IRS is still writing language to really, to convey what Congress meant with these, with the tax laws. Okay. And so that's the thing that you need to know. Like, people hate the IRS. The IRS is the enforcer. Congress makes the laws, and then the IRS has to write the language to enforce the law. And that's their job. Okay. So if you don't like your tax laws, then you need to vote against your congressman. Okay. Or if they voted against it, then you need to vote for them. Whatever, you need to vote. All right, so let's get down to it. Number one is moving expenses, okay? Now, prior to January 1, 2018, if you moved more than 50 miles from your job for a job-related, as a job-related move, then you could deduct those moving expenses on your taxes. That is no longer available. So if you moved for your job in 2018, I don't care if it costs you $20,000, you cannot deduct that. Now, the IRS just stated Friday, though, the one thing that's a little bit of a help, but not really. It's like you kind of do it, but you don't. So if you incurred moving expenses in 2017, but you didn't get paid for that or whatever until 2018, then you can deduct those. So like if your employer reimbursed your moving expenses for you, then you don't have to count that as income. If the move actually occurred in 2017, but you didn't get reimbursed until 2018, that has to be made clear. But now if you moved in 2018 and your employer, pays for your moving, that's going to be counted as income for you. So even though, it might be, they relocated you from Maryland to California, and that would be a pretty hefty move. And trust me, I have paid that price tag. Okay. That would be counted as income for you in 2018 if they paid for that. So watch out and be ready for that. Okay. So that's moving expenses. And that does not apply to active duty military people because, hey, we move when the military says move, not when we get ready. All right. And if you have been around me for long enough, y'all have seen the transitions. Okay. Enough of moving expenses. Number 2, and I actually just got a question about this. Unreimbursed job expenses are no longer available as of January 1, 2018. What does that mean? So if you have to buy uniform stuff for your job, like if you have to buy uniform shirts for your job, if you have to purchase any type of equipment and everything, that used to be a tax deductible expense. It is not anymore. We're talking about continuing education, union dues, license fees. If you have to take, like with some places, you have to take drug tests. If you have to pay for drug tests and stuff, you don't get reimbursed for that. You can't claim that as a tax deduction anymore. Now, can your employer reimburse you? Absolutely. But if they don't, then you can't claim that as a tax deduction on your taxes anymore. Okay. So, that is I mean, it is what it is. So also, now you have some people who actually have a job, a W-2 job that you work from home. You can no longer deduct the home office expense. It's not tax deductible for you. So even though you may work from home, a W-2 job, but prior to 2018, through December 31st, 2017, you could deduct your home office and all those things that are, related to your home office and that portion of your expenses and all of that. Starting January 1, 2018, if you work a W-2 job from your home, you can no longer deduct home office expenses. And that's just the way it is. That one, especially working from home myself, that was like a stab in the heart to me, because you do have some people who have jobs that allow them to work from home, or, that was just the nature of the beast to begin with, to work remotely. But now you can't deduct those expenses anymore. All right. Number 3, tax preparation fees. Okay. So if hey, it used to be tax deductible starting January 1, 2018. You cannot deduct the cost of your tax preparation, your meetings with your accountants on your personal taxes. Now, if you have a home business, the portion of your tax preparation fee that's related to the business part of your taxes. So your Schedule C, if you have a rental property, is Schedule E. If you have those type things, the portion of your tax preparation fee that's related to the business is tax deductible. But any tax preparation fee related to your personal taxes is not tax deductible. So here's how that looks. So let's say, for instance, if you go to a tax professional and they say, okay, my base rate is $200, okay? Then that's for your personal taxes. And let's say they charge you $150 for your Schedule C and another, $100 for your Schedule E. So we're up to like $350, $400, right? I think that's what I said. But anyway, that $200, that is that base fee, that's like your personal taxes. You can't deduct that. You can only deduct the part of your tax preparation fee that's related to your business. Okay. So you have to look at that with your fee, because a lot of people charge a flat rate. So then the question becomes, what part of that is personal and what part of that is business? Okay. So just know that as a business owner, you can no longer deduct the entire cost on your taxes. You can only deduct the business portion. That would be on your Schedule C or your Schedule E. But what used to be your Schedule A, not there anymore. So for people who just have personal tax preparation, no, you can no longer deduct the fees not even for the software. Okay, for real. All right, number 4. I think I'm on number 4. Personal exemptions, you guys. Okay, so everybody was like, turning backflips, like, woohoo, we doubled the standard deduction. Yes, hallelujah. Okay, but with that also came removing the exemptions of $4,050. And so the way that exemptions worked is that you got to reduce your income by $4,050 for every person in your home. Now, if you were a family that had, like a family of 4, like a couple and 2 kids, then you're going to work out at about even on doubling the standard deduction. However, if you got more than 3 kids, you're going to lose in that portion of the tax, the tax deduction. Okay. And that's just the math on it. Now, there are other credits and things that come along with that. But when you think about, if you have, let's say, a college kid that you're still helping to care for, where you would normally be able to claim a $4,000 exemption for them, you can't do that anymore because they are too old for any other type of credits. And so you won't get that $4,000 exemption for them anymore. So just as an example. All right. So yeah, doubling the standard deduction, well, almost doubling. It's almost, right? So like married filing jointly, your standard deduction for 2017 was $12,700, where for 2018 is $24,000. And as for each filing status, it almost doubled. But with that, they removed the deductions and they removed the exemption, the $4,050 exemption, and a lot of the itemized deductions that you're used to having. Okay. And then there are limits on other itemized deductions. That's a whole nother Facebook Live. Okay. Now, another thing that is not a deduction, but it's one of those things that you really, really need to be aware of and really need to get. Okay, so, way back when we had the whole mortgage crisis, right? There were a lot of people that were going through some stuff, and a lot of people lost their homes. And so there was, don't ask me the name of the act. It was like 6 miles long, but nuts and bolts is that during the Obama administration, Congress passed an act that said if you had debt forgiven that was related to real estate that was secured by a mortgage on your principal residence, then that additional debt, like if you had to short sell your house, would not be counted as income. That is no longer in play. Okay, so starting January 1, 2018, unless Congress come up with some other mess and do like they did last year and change it in like December or January as a mess. If you have a short sale on your home, the difference in the sale is now going to be counted as income and will be taxable. So how does that look? Let's say that you have a home that you owe $300,000 on. However, the fair market value at the time is $250, or they sell it for $250. That's a difference of $50,000. Okay. And it's happening. Now that $50,000 will now be counted as income for you. You'll receive a 1099-C in the mail. If you get a 1099-C, yes, you need to report it. And so then you would owe income tax on that additional $50,000. So depending on your tax bracket, that can be, let's say if you in 50, we're going to do some quick math, $50,000 time a 0.15 tax bracket, you could easily have an additional $7,500 to the IRS, right? So that's just something for you to be aware of going in if you are in that particular situation. This past tax season, it was actually supposed to, that whole thing was supposed to start then, but then in like January, they were like, okay, no, we're not going to do that. So there are a lot of people that had to file, that had already filed their taxes, that then had to go back and amend so they didn't have to pay. But now, as far as I know, that is gone. Okay. So if you had to deal with a short sale of your home in 2018, if there was whatever that difference was, you should expect to receive a 1099-C and expect to pay income taxes on the difference in the sale. Okay, so I hope I explained that as thoroughly as possible on this Facebook Live. So that's it, you guys. Those are like the 5, I believe, that are major things that are that disappeared for 2018. There's other stuff, you guys. So this is why I am really encouraging you to not listen. I keep saying this. This is not the year to let random folk just do your taxes. Okay, it's just not. There will be a lot fewer people itemizing. Okay. And that's with doubling the standard deduction and the other limits that you have to meet, there are going to be a lot fewer people itemizing, which, you know what, if you fall into that category, then absolutely fine. But if you have a business, listen, do not let random folk do your taxes. And the reason I say that is because, like I said at the beginning, the IRS is still writing the language to explain what Congress actually meant, which means that software developers are having to play catch up. So you need to make sure that you are in contact with somebody that knows what the law is supposed to be and how it applies to you. Because otherwise you're going to, inadvertently wind up in some tax trouble. And, I'm just telling you, this is not the year to be cheap. This is not the year to go to Ray Ray and Pookie Nim. It's not the year to go to the freaking car dealership and the grocery store and all of that to get your tax returns done. Yes, they do. The grocery store and the car dealerships. Yes, everybody want to be tax preparers, because they want to get their hands on your refund if you're getting one, right? But yeah, this is just not the time. The other thing is that if you're an employee, you really, really, really need to check your W-4. Okay. The other thing that happened, this is a bonus. I'm going to say this and then I'm going to be quiet. With the W-4, with the IRS, they issued a new W-4 for 2018. And they are highly, highly encouraging you to get with your HR to review your allowances and all that, because, they are estimating that some 20 to 30% of people will be under withholding, which means that there are going to be some people that are going to receive a tax bill that they're not expecting. Because normally when there's a change in the W-4, everybody's got to go to HR, right? And everybody's got to go to HR and redo their W-4 and life is good. But not with this one. With 2018, they just made these adjustments automatically. Okay? So you need to be prudent in your stuff. If you are an employee, go check your W-4 and make sure that you got your allowances and stuff right. And the way to do that this close to the end of the year is you need to look at what your total withholdings are. And then you need your taxes from last year to see what your total tax bill was. Everybody has a total tax, okay? Look on, it depends on the form, but you have a line that says total tax. That's what your tax due is. So look on last year's taxes, look at your withholdings to date, see if you're on track. If you're not and you need to withhold a little more, then you need to get HR on it so that you're not having to write a check that you're not necessarily prepared to write come tax time, okay? So that's it for today's episode of Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come here to get your questions answered about your home business taxes. And if you need to book a consult, you can do so right here. I offer a 15-minute complimentary consult to see what your needs are. And then if we need to book a further consult, we can do it at that time. All right. Have a great day and I'll see y'all next time. Bye.